Hi everyone. In this video I'm using a template that is on my website. You can download it from there. And I have entered in information regarding General Motors. Now this data, I happened to save it because when General Motors went into bankruptcy, I decided it might actually be a really good teaching tool. And so I have the 2006, 2007, and 2008 data for General Motors. So let's walk through this using the template that I have uploaded on my website. So first of all, let's look at current ratio. The current ratio is the current assets divided by current liabilities. Now, the way that I like to teach this is I tell students to think about your own financial situation. If you have more assets than you have liabilities, you would probably feel pretty good about that, right? You don't want to have more liabilities than you have assets, especially current assets and liabilities. That would be bad. Okay, so in this case, we want the current ratio to be 1 or better. We would like for it to be 4 or 5 if it could be, you know. A lot of companies will be around the 1 mark, maybe probably better than that. A lot of times Starbucks is at around 2 or 3, somewhere along in there. But General Motors, as you can see, from 2006 to 2008, their current ratio was deteriorating, meaning they had a lot more current debt that they had to pay than they had current assets to pay for it, which is not a good position to be in. Now, when we look at the quick ratio, we look at that one and we take the current assets and we subtract out of it inventory. Sometimes inventory can sit for a while. So sometimes you want to see the effect that inventory has on the current ratio. So the quick ratio takes inventory out of this. So when we take inventory out of the current assets and then divide by current liabilities, their ratio is even worse. We would like for that to be 1 or better as well. But as you can see, the effect of inventory definitely drops it by at least 2 percentage points. The accounts receivable turnover, there what we're doing is we're taking net sales or revenue, sometimes those are synonymous, and we're dividing by the average accounts receivable. So that's why in 2006 I have not calculated the turnover rate. And the reason for that is that I don't have 2005 data in order to do the average of the accounts receivable. So I've only calculated a turnover rate for 2008 and 2007. So accounts receivable is turning in 2008 at 17 times a year, in 2007 at 20 times a year, and then right below it, the days to collect is related to this turnover. So basically, we're calculating how many times it's turning in the first calculation, but in the second one, we're looking at how many days is it turning. So we take 365 days a year and divide by that accounts receivable turnover that we calculated just above it. So it's taking 21 days to collect their accounts receivable in 2008, and it took 18 days in 2007. So not horrible, and we don't have a whole lot of historical information about General Motors to know whether or not this is okay or not, but it is deteriorating just like the other ones are. Inventory turnover takes cost of goods sold and you divide by the average inventory. And again, because we don't have 2005 data, I didn't have the 2005 inventory, so I couldn't do an average. So I only calculated inventory turnover for 2008 and 2007. So inventory turnover, they're turning at around 10 to 11 times a year. And then we look at the inventory turnover days to sell, and that is where we take 365 days a year and divide by the inventory turnover rate that we just calculated, and we get, it takes 33 or around almost 34 days to sell something in 2008, and it took almost 32 days in 2007. So still deteriorating, but we don't have a whole lot of information to give us a really good clue as to whether or not that's really bad or not. Now, the debt to assets ratio, this is a solvency ratio, and this is telling us that for the long term, will they be able to survive? And this is a very disturbing number for General Motors because we want our total assets to be greater than our total debt. So we actually want this number to be lower than 1, and the smaller the better. But as you can see, it has almost doubled in 2 years, which is a very bad situation, because what is happening is that they have so much debt that they have to pay off over time. They're most likely not going to have enough money to actually pay it off. And, think about your own life. Think about, if you are highly leveraged, if you have so much long-term debt, like you have mortgages and you have really huge balances on your credit cards, you put yourself into a really tenuous position. And it's the same thing with an organization. And then our gross profit margin, which is taking gross profit divided by net sales, you can see that from 2006 to 2008, the gross profit margin has completely eroded, and the net profit margin has been a loss for all 3 years. Now, since a company will report quarterly, there are also quarterly reports that they publish. It should be no surprise that by 2008, this company went under. So that is why I want you to be able to be, at least to some degree, to some level of financial ratio analysis, that you feel comfortable doing this for yourself so that you can see just how things truly are and make your own assessment of it. Because a lot of people probably lost 401k money, they probably lost all kinds of stuff. They were probably invested in General Motors stock, and CEOs probably told them to keep it in there, etc., that they were going to rally and they were going to fix it and blah, blah, blah. But I want you to be able to make your own choices, separate of what they may say. Because numbers, while sometimes it's kind of hard to tell exactly where that sweet spot is, as far as like if something's going to come back or if something's really falling off a cliff, this should have given investors and employees alike a pretty good indication that things were not okay. So anyway, if you have any questions about that, please leave your questions below. I'll be happy to help out, and I look forward to talking with you on another video.